Okay, thank you very much. I will just cover what's happening in global economy with some conclusions also that are relevant, obviously, for construction sector and for Contact in particular. So we are living in really extraordinary times because just 2 years ago we had COVID pandemics, and we thought that the light at the end of the tunnel is coming, but then the train is coming, actually, it appeared. Yeah, we have Ukraine war, but during the this turbulence period, so COVID pandemics, actually Baltic states did pretty good. One of the best results in terms of GDP. The drop was very, very short, and the recovery was really fast. So out of these scenarios that were being made, will it be like U-shaped? We remember V-shaped or L-shaped. We definitely have V-shaped for victory. Okay, Latvia is a little bit lagging behind. We call Latvia Sleeping Beauty. They have this potential, not used yet, but still they are also doing quite okay, and Lithuania and Estonia are moving forward. Now, what is interesting is what caused these developments so good, and the key driving force was actually the manufacturing sector. So manufacturing sector was number one. Then we had a high-tech service sector and also construction and real estate sector. So those three sectors basically contributed positively to economic growth, and as a result, we had this very nice overall GDP figures. Talking about manufacturing, okay, Lithuania is actually leading in the Baltics, but why we managed to achieve these nice results or good results is that we gained somewhat competitive advantage during this transformation from just-in-time to just-in-case operational mode. Yeah, because, like, for example, Germany, 90% of companies got stuck with their supply chains because those chains are scattered throughout the globe, most coming through or from China, and now they have really big headaches. And for Baltic states, those chains are shorter and we are more flexible, so we managed to use this competitive advantage and even to take away some market shares from our competitors, in particular Germany, because in the Baltic states, the share of companies that are having issues with supply chains, with lack of material equipment, is only 20 to 30%, 2 times lower than EU average, and in Germany it's close to 90%. Okay, talking about high-tech services, we are really doing pretty good, I would say. Estonia, in particular, we managed to attract some huge investments, like Volkswagen IT Center moved to, statistically at least, and in fact, actually, actual exports jumped. Lithuania was lagging behind, but now we are catching up. And we also have our fintech sector, which we can be proud of, which allowed also Lithuania to become one of the biggest, actually, exporters of financial services in the European Union and also globally, especially if you measure it on per capita basis. So these two parts are okay. The third part was also okay. It's construction and real estate. We even had not a V-shaped but G-shaped, probably, this curve. So recovery was fast, much faster than many of us expected. Not probably me, because I already found information how real estate sector developed after SARS pandemics in Hong Kong. Yeah, and the following year, real estate prices increased by roughly 30%. So basically, it's, pandemics come and goes, but economic stimulus stays. Usually, countries tend to overstimulate, and that's the result of this. We have very high jumps in prices in all 3 Baltic states, and also you can see that bank behavior was completely different this time. So actually, financing for house loans increased. They are around 50–70% higher compared to pre-crisis level. And in all Baltic states, you see the development is very, very similar. But then, of course, we have this train coming. Yeah, trains coming towards us, and extra risks appear. So first is obviously what many of us talking about is Russian invasion of Ukraine. So it will have direct effect because we will lose Russian, Belarusian markets, not only export but also import. Partial loss of Ukrainian market also, which is more important for Lithuania, for Latvia, Estonia, not so much. And then also there will be definitely indirect effects due to increased uncertainty and loss of confidence, both consumers and investors. But the second thing also we're fighting several wars with Russia. The second war is energy war, and it's a hybrid war. So as you know, Russians already switched off gas. Actually, they started it already last summer. And they kept gas storages half empty, or not even half empty, or empty. Let's put it like this. And they switched on this gas pipeline. So as a result, we have a huge jump in gas prices, electricity prices, and also other commodity prices due to broken supply chains. And on top of that, we have China, which got stuck with zero COVID strategy, and again, this supply chains, global supply chains are being stuck. And on top of that, this time it's different because 2 years ago, countries were flooding markets with money, yeah, and now they are doing opposite. They are raising interest rates. They are saying, no, it's enough because we have inflation. People don't like inflation. They get angry. Yeah, and people get angry in US, in Europe. And even Marine Le Pen was catching up with Macron, yeah, in France, because she was stressing this rising costs of living, inflation, etc. So we should do something. She was offering some awful things, but that's good that she didn't win. Yeah, okay. So then, yeah, but you know the path is forward, and many countries are afraid that this can repeat anywhere else. But there are some risk mitigating factors, still higher public spending in Baltics especially, because we have many refugees. Also, you need money to allocate for this. You need money for defense. You need money for renewable energy. Also, some jump in prices like wheat, timber, for example, are more like beneficial for our countries because we produce ourselves quite a lot of this. And higher NATO use military, usually there's a very positive correlation. The more soldiers you have from US, the better economic developments of the country, historically. Like, take it South Korea, Taiwan, whichever country, Japan, usually it's positive, unless they start fighting. So as long as the fight is not going in the country, then it's nice. So as a result, we were forced basically to change our forecast. We increased inflation forecast quite substantially, especially for Lithuania and Estonia, above 10% annual average. GDP, we still expect that we could avoid overall drop in GDP, but it will be barely above zero. And we have already some signs that, for example, today it was announced that GDP grew by 4.1% first quarter, so yes, we expected. But like in France, for example, it's already flat. In US, it's even dropped, but there are some technical reasons for that. Yeah, so basically we live again in this uncertainty. Again, we draw these letters, yeah, J, U, L, depending on how things will get in Ukraine. So far, our baseline, we assume this U-shaped scenario that it will take some time until the conflict ends. Let's hope that J this has more probability. L, fortunately, is pretty unlikely becoming. Like in the end of February, we were really scared, every one of us. But now we see that, thanks God, Ukraine managed to kind of stop the invasion to a large extent, and as a result, this scenario became not very likely. So just a few positive slides why we think that we should avoid this like outright recession in the Baltics. It's because we have, despite being neighbors of Russia, we have pretty low exposure to Russia. Our direct exports constitute only like 0.7 in Lithuania, 0.9 Estonia, 1.3 Latvia % of GDP, which is not that high. And this dropped actually quite substantially already in 2014, 2015. So basically, we should thank Russia that they imposed sanctions on us, because back then we actually took a hit. And back then our economic situation was pretty good. We were about to introduce euro in Lithuania. Latvia was just had introduced it, and basically this was somehow not very visible at that time. And now the drop actually, if we would completely even lose the Russian market, would be even less a bit than we had 2014, 2015. We have a higher exposure in service sectors. That's yes, and some transport companies will have some challenges. But again, the importance of Russian market have been in decline over the last years. And especially contrary to probably intensive export of goods, this decline accelerated since 2020 when we had riots and protests riots everywhere else in protests in Belarus in 2020, and then we had this decline. And finally, what is probably more important now for us, or all of us, also for construction sector, is not the exports to Russia and Belarus, but imports from Belarus and Russia, because we were importing quite a lot of metals, wood, other commodities, and obviously it's a headache for some companies, especially for construction companies, because it's not easy to find alternatives. They usually sometimes are way more expensive, or the delivery time is much longer. Of course, there will be some roundabouts probably found through other countries that are not coming under sanctions, but still for a temporary period, we will feel some inconveniences. And finally, this second front, as I mentioned, this energy front, I just illustrate with graphs what I told. So basically, it all started already in mid-2021, when Russia didn't fill up these storage facilities. You can see, like in Germany, 3 larger storage facilities, and guess not difficult to guess which one is from Gazprom. Yeah, the red one. Yeah, so basically it was very obvious already back then, and I wrote about it many times. But somehow politicians didn't notice that, which is very strange. Not our politicians, German politicians, yeah. And then you see these spikes in gas prices. Obviously, these spikes in gas prices translate into spikes in electricity prices, because it's like a connected system, since some of electricity, around 20–25%, is produced from gas. And then you have increase in CO2 emission allowance prices, because again, countries start producing more electricity from coal. They need to buy these emission allowances, and then the price goes up. So basically, the whole electricity market is also shooting up. And on top of that, since the invasion already started, we had also on top of that jump in oil prices, especially in euros. Measured, I just provide not in US dollars per barrels, which is not very understandable, but it's just euro cents per liter, and you can see that it's a record high actually price, because also euro weakened against US dollar and price increased. So we have a pretty nasty situation that in all fronts we have this inflationary pressure. Thanks God, we, in terms of energy dependence, I will not talk too much into detail, but we are doing quite good. It was announced that Lithuania was the first EU country that kind of got rid of Russian gas. Publicly, it was very good, and actually, Lithuania is very, very well known now globally. So we should use this opportunity actually, because even Chinese know Lithuania now. 1 billion people. Yeah, they are even actually afraid a bit. There's like a kind of an anecdote that one guy from China, they have this separate kind of department that analyzes communist regimes globally, because they are a communist country, like formally, and then they meet representative of our foreign ministry and ask, is it true that your foreign minister is Landsbergis? And they said, yes, it's true. And then, is it the same Landsbergis that destroyed Soviet Union? And I said, no, it's not. Yeah, it's okay then, no problem. Yeah, but it's like a kind of a joke, but not. Yeah, you never know. But this actually is good from PR perspective, that we didn't wait until Russia switches off gas for us. We first told that we don't need them. And then, of course, we not only tell, we had made quite the decisions in the past. We have LNG terminal, we have connections with Poland. Poland now will have in October with Norway. So we will be independent from Russian energy imports, and also we don't import any more oil. So this is nice part. Not nice part is that still, despite being independent, we have to pay high prices, and those high prices fuel inflation. Inflation is skyrocketing. It's reached more than 15%. Now preliminary data is already for April, so it's 16.8, I think, or something like that. So probably will not reach 20, but very close to it. Food prices also jumping. But the positive probably thing is that in some segments, price stabilization is being already observed, and I don't believe myself. I analyzed quite a long period of time that usually these spikes, especially in commodities, they are not lasting very long. Yeah, because supply-demand mismatch translates into increased supply, decreased demand, and that's why you should be careful not to think that it will be high prices forever. Of course, now uncertainty is very huge. It can be worse before it will get better. Probably it will, because Russia is still preparing us for next winter already. Yeah, we are keeping, switching off gas, keeping storage low, etc. We're doing everything to make our pain as much as big as possible. Also with wheat prices, etc. But longer term or in medium term perspective, one could expect that these prices should converge back to some historical averages. And already now you see some metals actually have stopped increasing. Probably they will continue to do so. But of course, as I mentioned, for this year it can still get worse, because we don't know what will happen with the situation in Ukraine. And also China adds fuel to the fire, because they still keep the zero COVID policy, and this will probably further strain supply chains, because a very big part of China now is being closed. Yeah, and then for next year, I'm quite becoming more and more convinced that we will see pretty reduced price pressure, is because monetary policy is being tightened quite aggressively. Now in US, they expect that interest rates will rise already by the end of this year, close to 3%, above 2.5, and then will stabilize around 3%. So this would be a pretty huge increase. And some countries already did that. Czech Republic, Poland, we already have almost 4-5% interest rates. Imagine Lithuania 4.5% interest rate. Okay, probably in euro area we will not have it. I don't believe that we will have any major increases because of these political issues, and the Southern Europe will start complaining, oh, my debt is too high, blah, blah, blah. In Italy, etc., we need this fight climate change and not increase interest rates and so on. But still, United States is a global supermarket, as I call it, and when they increase rates and will stop also real estate sector is already now, kind of dropped below 2019 levels. So probably we'll have a good, nice American roller coaster this year. And as a result, probably we might have also some extreme swings in commodity prices. Like in timber prices in US, for example, we're swinging very, very strongly. I didn't include graph, but it's a very interesting graph. So whenever there's like expectation that, wow, real estate market will go, prices go high very, very much. And then last spring, for example, they dropped quite substantially. Then they increased again. And probably due to this, they will drop this summer again. Yeah, and in euro area, as I mentioned, probably interest rates will not be raised that high. Still, market expects actually even up to 1.6% Euribor. That's also would be pretty kind of material, especially given that the house prices are at record high levels in all euro area. Not so much in Lithuania, but like in France, for example, yeah, we are like very high. So even moderate rise in interest rates could actually have also repercussions, and this cyclicality probably we will see. And last slide, so that's official forecast of inflation, but the European Central Bank is doing. They are doing very bad recently because they are consistently underestimated. They consistently overestimated inflation from 2009 to 2021, because we were always expecting that inflation will converge to 2%. It never did. Now we are underestimating. We didn't expect this jump to be so high, but for the next year we forecast again a less than 2% inflation. So this also should be kept in mind. And for you, what is important, and for this sector, is that once we will stop having this excess demand and we will stop having these price pressures, then again, things that will become more important is efficiency, how efficient you do, how cost efficient you do, how technological efficient you do. Because now everything is like messed up, so these things are not that important. Most important to get material, yeah, to get at least something, and somehow to try to guess what awaits us in the future. But once things will settle down, these technological and efficiency things will become more and more important. And I would, even my still opinion, I keep it, I think we will have a period of still stagnating prices for the upcoming few years. I really don't big believer that we will have this inflation like persistent. I think we will have pretty big drop already in the end of this year, and then in the next half of, in the second half of next year, probably will go into negative territory. Yeah, so that's my half full glass presentation, not half empty. Yeah.
Thank you very much, Žygimantas. Please stay a little bit. We have some questions from the audience. If you could go to slide number 2, if it's possible still.
I go. This is the beginning. First slide, yeah? Yes.
Yeah. So the question is from the audience, what do you think, what is the reason of the success of Ireland? What's behind that?
The economic structure was very favorable for this crisis because we have a huge IT sector, huge biotech sector, and basically beer sector, which used to be Guinness sector, which used to be big, now not so big anymore. It's actually economic structure, and it's not even GDP for Ireland. You see this is an asterisk. It's GMP. GDP is even higher. GDP was more than 20%. Yeah. Because companies just move the headquarters, but it's just a real growth. It's amazing, actually. Yeah, it's just economic structure, and also for Baltic states, it was similar because compared to like Spain, Portugal, Italy, we have huge leisure sector activities, so they suffered a lot. And our economists I mentioned, like manufacturing did very good because of this short supply chains, also. IT sector, and also construction somehow recovered very fast. So that's the reason why we did so good. Also confidence. Before, you know, it's also kind of, you should maybe not compare absolute figures, but you should compare what we would have been growing and what we grew, like this difference, yeah? Because we would have been growing much faster if a crisis wouldn't have happened, compared to, let's say, Greece and Spain, because our inertia was very strong when crisis started. So probably it would have been like 8% plus if no crisis, or maybe even 10.
Okay, and once again, what's your suggestion now? So as you mentioned, it's a lot of turbulence now, but we should prepare for what as a construction business?
In the short term, for everything. In the longer term, for increased competition, and generally, always tech revolution in general will definitely increase competition. Longer term, could put pressure on cost base, and also probably will lower inflation, because also it's related to like. Fifth revolution basically first came during the industrial revolution times in manufacturing sector. So we learned how to produce things very fast, but we didn't know how to sell those things pretty fast and efficient. Now we learn how to sell them, and now this revolution comes also to other sectors, like construction sector, where you use lots of manual labor. So it's spreading, and once it spreads, the cost base usually drops. That's at least historical. Like, for example, during industrial times, the whole textile sector of India was almost destroyed by Britain because it was so much efficient to do it in Britain that India lost its competitive advantage. So if you don't do it, you might be in trouble, you know. Some guys will start printing, you know, they call it, of course, but not print, but like printing houses, etc., and they might become pretty cheap to build. And if you will continue using old technologies, then you may lose the competitive advantage. And also people's kind of behavior changes. They demand more and more these tech features, etc. So it also should be taken into account.
Yeah, I think human resources is and will be a problem as well.
Oh yes, human resources
in engineering
will be diminishing, continue to diminishing, because also we have like this influx, temporary influx of Ukrainians. But longer term, obviously, this labor force will be pretty scarce resource in the European Union as a whole, and in particular in Lithuania. And even in other countries like China, I think will do many things, because if you look at the recent statistics, birth rate in China dropped 2 times during this crisis, COVID crisis. So yeah, in some years we will have really huge challenges with this.
Okay, thank you, Žygimantas, very much.
Okay, thank you.
Thank you.